The banks have been and non-banks as well, have been borrowing from the government, from the Federal Reserve rather, at the highest levels that we've seen. Why? Because on the way up, all that debt and leverage makes everything look fabulous. But on the way down, it destroys that wealth very, very rapidly. So I'm going to read this to you, and the dispute centers on asset-based financing. We've talked about this before, and you know, you always have to be careful of how they name something, because quite honestly, it's usually just the opposite. And I really need you to be aware of that so that you don't fall for that in the future. So what is asset-based financing? It's a type of private credit deal where lenders extend funds secured by cash flows or receivables from the borrower's business. So it works, again, as long as everything is going hunky-dory, there's no problem. But when it starts to reverse, that's when it's like a tide, right? As long as that tide is high, you can't see the garbage on the bottom of the ocean floor. When that tide goes out, that's when you see it. And we are at a place where the tide is going out. And remember, the central banks only have one tool, and that's money printing and interest rates. And they're lowering the interest rates into an environment that is already easy money. So I gotta tell you, we have seen nothing yet in terms of inflation. But the market has ballooned alongside the broader private credit boom, now topping 1.7 trillion globally as non-bank lenders rush to fill a void left by the traditional banks. But a series of collapses, which we've talked about, include the First Brands and the Tricolor Auto Group, both accused of pledging questionable assets. See, we've talked about this as well. In that reach to yield, right? 15 years at zero interest rate policy. So companies were reaching and taking more risk and not looking at really what was underneath the surface. Oh, in a zero interest rate environment, 4% interest is great. I even had somebody ask that question when I just did the event with Greg Manarino. Well, but gold doesn't pay any yield. Gold doesn't have to pay you yield because it is the single safest thing that you can do. It runs zero counterparty risk. All of this other stuff runs all counterparty risk. So what we're witnessing is the implosion of a system. And what's the government's answer? What's the central bank answer? Printing more money, that devaluation trade. Let's make the dollars that are out there in the US or other places also have dollars. But whatever the currency, whatever the current fiat money is in your local, wherever you're watching from, you just make that worth less and less and less. And then that makes those fiat money assets look like they go up. And even gold. Gold has not changed. It's the value in terms of the government's debt-based money that has changed and been devalued. And this is why it is so critically important for you to become your own central bank. And even if you make the choice to hold intangible wealth, you need to do whatever you're comfortable doing. Proper diversification requires you to hold a certain level of gold so that if those other things go away, you're covered. It doesn't matter. So now, since we're kind of short on time, do we have some questions?
Yeah, so one of the questions that came through from Colleen Allen, she asked, what is the name of the smallest pre-1933 USA circulated gold coin one can purchase?
$1. Now, the $1 coin, which is teeny weeny, I've shown it to you a bunch of times. It's a 20th of an ounce of gold. It can make a lot of sense. But again, when we're doing that strategy, it's a layered approach. So you want a variety of sizes. And again, remember, gold and silver in any form is monetary at its base. So it's always best to call us, establish your goals, and then we can help guide you as to what kind of gold and what kind of silver is going to support that best. But the smallest is the $1 gold coin, which is a 1/20 of an ounce of gold.
Okay, next one comes from Rob on the Road. Says, if QT ends, where will all the added liquidity go? T-bills?
Oh my goodness. QT is quantitative tightening. And they want you to believe, they being the central banks, that they've been tightening because they've been running off their balance sheet. In other words, all of that, the government bonds that the central bank bought, the Fed bought, they've just been allowing them to mature and not reinvesting that principal or those dividends. So the liquidity, QT is supposed to be pulling the liquidity out of the system, but it really hasn't been. And I've shown you in the past, and you can go to the FRED, F-R-E-D, the Federal Reserve Education Department, and you can put in there the liquidity conditions or the credit conditions. And you're going to see that there hasn't been any QT. Now, where the QT comes in is in the crisis like we're witnessing today. That liquidity, because of those defaults, have been sucked out of the system, which has forced those non-banks and also the banks. This is not just a non-bank issue, because remember, those non-banks, that private credit, that private equity has been going and getting money from the banks. And that's the problem, is the contagion. So when they see that these private events are starting to fail, that's where the money is sucked out and the liquidity is put back in the system through the repo facilities and through dropping those interest rates down. So they're basically giving you free money. And keep in mind that interest rates are also an indication of the value of money. And it was at zero interest rate policy for 15 years, and it's going there again. And it'll probably go to negative rates, even in the US. So that's where the liquidity is coming from: money printing, lowering interest rates, and the Fed's facilities that they just create out of thin air and create all of that money to push back in the system so that you don't know. Because you should also remember that a lot of that liquidity comes from money market funds. Money market funds, even though they're sold to you as $1 in, $1 out, well, that's not really the case anymore. And that is the plumbing that lies underneath the global financial system. So all that flow of cash, they need your deposits into that money market fund. And we saw this in 2008. We also saw it again in 2020, that were actually September of 2019, when the plumbing actually got clogged. That could very well be happening right now with these implosions. So if you're sitting in money market funds and they are not government money market funds, you should be concerned. And if you can get out, get out. And remember, they've also put in fees and gates to prevent you from wanting to get out. Because the key in here is, how much do we have to charge so that you decide to stay put? It's not worth risking your principal. It isn't.
All right, and this one says, this one's more of a statement, but I'd like to get your opinion on it. Silver EN7KL says, money printer started up and gold and silver get slammed down. Makes no sense.
Makes all the sense in the world. There are a few things that happen in here. Number one, a rise in gold and silver prices are an indication of a failing currency and a looming crisis. I hope everybody watching this can see that we are already in crisis. That's one thing. Another thing is that the gold and silver are used, especially inside of the system. So this is just paper gold and silver. They can create as much of that at will as they want to. And that those contracts, spot gold, spot silver, that's what you're really talking about here. Those are simply paper contracts. And remember, it was back in January when, especially the Bank of England, but there was a lot of physical gold and silver that was shipped over here to the US and then delivered out. And we talked about the backwardation. In other words, current prices being higher than future prices because entities do not want to risk not getting their gold and silver. Because the futures contract, the assumption is there's a specified date at a specified price that you can, anyway, in theory, take possession of the physical metals. But the US was not really about taking possession of the physical metals. It's just trading those paper contracts or those digital contracts back and forth. So if an area over here is imploding, well, they get what's called margin calls. And if they've done this using those contracts as collateral, and they have to liquidate those paper or those digital contracts in gold and silver to meet those margin calls. But the physical world does not work like that. In the physical world, it is simply supply and demand. That's why I show you the charts on the PCGS 3000 and the ultra rarities, because that's the only place where I can really show you what's happening in the physical demand world. If you're looking at what Wall Street puts out, the spot gold contracts, the spot silver contract. So when they say, when you're listening to Bloomberg or CNBC, or even when they put across the ticker gold, put spot in your mind, put spot in front of that so that you are seeing that that's a contract price and has nothing or not much, because it does have a little bit to do, but not much to do in the purely physical world. And there's bullion that will reflect what happens in those spot contracts more. The collectible coins do not. That is purely a supply and demand market. And look, I think diversity in everything makes a whole lot of sense, even though I'm not, honestly, I'm not really that diversified because I don't own any of those intangibles, but I do have dollars. So diversification is key. Okay, well, that's it for today. Thank you for showing up here. Stay tuned, lots more to come.